Ladies and gentlemen, the Asian man is here, not to excite you, not to scare you, but to place facts on the table, cold, structured, and unavoidable. Because while markets argue over short-term volatility, interest rate guesses, and daily headlines, a much larger story is unfolding quietly in the background. A story about silver, a market so small that it can be distorted, a metal so essential that it cannot be replaced, and an asset so misunderstood that its price no longer reflects reality. Silver today is not trading where it should be. It is trading where it is allowed to be. And that difference is everything. Silver occupies a unique position in the global system. It is both a monetary metal and an industrial input. Gold is hoarded, copper is consumed. Silver is both stored and destroyed, used once in electronics, solar panels, medical equipment, defense systems, and then lost forever. This creates a structural contradiction. Monetary demand wants silver preserved. Industrial demand requires silver sacrificed. No market can survive that contradiction indefinitely. For decades, silver benefited from large above-ground inventories built during the 20th century. Governments held it, industries stockpiled it. Photography consumed enormous quantities and then collapsed, leaving reserves that masked future shortages. Those buffers are now gone. What remains is a modern economy that needs more silver every year, supplied by a mining system that cannot increase output fast enough, regardless of price. This is where the story turns uncomfortable. More than 2/3 of global silver production does not come from primary silver mines. It comes as a byproduct of copper, zinc, and lead mining. That means silver supply does not respond to silver demand. It responds to base metal economics. Even if silver prices double, miners will not suddenly flood the market with new supply unless copper prices justify new projects. This breaks the fundamental feedback loop that normally stabilizes commodity markets. Demand rises. Supply does not follow. Inventories fill the gap until they cannot. Over the last several years, the silver market has quietly slipped into persistent annual deficits. These are not temporary shortages caused by strikes or logistics. They are structural gaps between production and consumption. Each year, that gap is closed by drawing down existing inventories. And inventory drawdowns are not sustainable forever. At the same time, something else has changed, something many investors dismiss because it lacks drama. Capital is returning to silver through exchange-traded funds. ETF inflows do not reflect emotion. They reflect allocation decisions made by institutions, asset managers, and long-term portfolios. These players do not chase momentum. They build exposure while price is boring, liquidity is high, and headlines are quiet. Historically, major silver rallies have not started with price spikes. They have started with positioning. ETF inflows are not the cause of higher prices. They are the evidence that expectations are shifting. And expectations are shifting because macro conditions are changing. The global monetary system is under strain. Sovereign debt has reached levels that cannot be normalized without inflation, repression, or restructuring. Central banks can slow inflation temporarily, but they cannot restore purchasing power without destroying debtors. Silver, like gold, exists outside this system. But unlike gold, silver is directly embedded into the energy transition. A single solar panel requires silver. Multiply that by national decarbonization targets, grid expansion, battery infrastructure, and electric vehicles, and the numbers become impossible to ignore. This is not speculative demand. This is policy-mandated consumption. At the same time, military demand for silver is rising. Advanced electronics, precision weapons, and secure communications all depend on silver's conductivity and reliability. These are not optional uses. They are strategic. So silver faces pressure from every direction at once. Monetary hedging, industrial expansion, energy transition, defense requirements. And against this demand stands a supply base that is stagnant at best. This imbalance cannot be solved through efficiency. It cannot be solved through recycling at scale, and it cannot be solved through substitution without performance loss. It can only be solved through price. This is where the idea of $100 silver enters the conversation, not as a prediction, but as a consequence. Historically, silver has traded at far higher ratios relative to gold than it does today. During periods of monetary stress and industrial growth, silver has not merely followed gold, it has outperformed violently. Today's gold to silver ratio suggests silver is deeply undervalued relative to monetary conditions alone. When industrial demand is added, the mispricing becomes extreme. The reason this has not yet corrected lies in the structure of modern markets. Paper silver trades in volumes that dwarf physical supply. Futures and derivatives allow price to be managed without immediate physical delivery. But paper markets only work as long as physical metal is available when demanded. Once physical shortages become unavoidable, paper promises lose credibility. At that point, price does not adjust gradually, it gaps. Silver does not move like equities, it does not trend smoothly. It stays suppressed for years and then reprices in months. This is why silver rallies feel shocking. not because they are irrational, but because they correct years of distortion in compressed time. The market does not slowly walk toward balance. It snaps. Silver at $100 per ounce is not a claim about tomorrow. It is a statement about what happens when supply deficits, ETF accumulation, industrial necessity, and monetary stress converge. That convergence is no longer theoretical. It is underway. Silver is not waiting for permission to reprice. It is waiting for inventories to run low enough that price suppression becomes irrelevant. And when that moment arrives, the move will not ask for consensus. It will simply happen. The most critical mistake investors make when analyzing silver is assuming that demand behaves linearly. It does not. Silver demand moves in waves, driven by technology adoption curves, policy mandates, and capital rotation cycles. Once these forces align, demand accelerates faster than supply can respond, and the system breaks. Industrial demand for silver is no longer a side story. It is now the dominant force shaping the future of the market. Take solar energy. Every photovoltaic panel requires silver paste to function efficiently. As nations commit to net zero targets, solar installations are not optional, they are compulsory. Governments are subsidizing solar deployment at unprecedented scale, locking in future silver consumption years in advance. This demand is price inelastic. Even if silver prices rise significantly, panels will still be built because energy security and policy compliance override cost concerns. Electric vehicles add another layer of pressure. EVs use substantially more silver than internal combustion vehicles due to complex electronics, battery management systems, and charging infrastructure. As EV adoption accelerates globally, silver demand rises not gradually, but exponentially. Now combine this with the expansion of data centers, artificial intelligence infrastructure, 5G networks, and advanced computing systems. All require silver for conductivity, heat management, and reliability. There is no scalable substitute that delivers equivalent performance at the same efficiency. This is why industrial silver demand is not cyclical anymore. It is structural. At the same time, recycling, which many assume will solve shortages, faces hard physical limits. Much of the silver used in modern applications is dispersed in tiny quantities across millions of devices. Recovering it is expensive, energy-intensive, and often economically unviable. Recycling can supplement supply, but it cannot replace primary production. While industrial demand tightens the physical market, monetary dynamics are quietly adding fuel beneath the surface. Global confidence in fiat currencies is weakening, not dramatically, not overnight, but steadily. Persistent inflation, currency debasement, and rising debt burdens have altered long-term expectations. Investors are not panicking, but they are repositioning. Silver benefits uniquely from this environment. Unlike gold, which is often viewed as static wealth preservation, silver offers leverage to both monetary hedging and economic expansion. When capital rotates into hard assets, silver historically outperforms because it starts from a smaller base and faces tighter physical constraints. This dual role creates a reflexive feedback loop. Rising prices attract capital. Capital tightens supply. Tight supply accelerates price. This is where ETF behavior becomes decisive. When silver ETFs absorb physical metal, that metal is removed from the market. It does not circulate. It does not supply industry. It sits idle, backing shares. In previous cycles, ETF accumulation significantly amplified price moves, not because ETFs created demand, but because they restricted availability. As inventories fall, competition between industrial buyers and financial holders intensifies. Industrial buyers cannot simply wait for price dips. Their production lines depend on continuous supply. When availability tightens, they are forced to pay whatever price is necessary to secure material. This is when price stops reflecting sentiment and starts reflecting necessity. The paper market cannot resolve this tension. Futures contracts promise delivery, but they rely on the assumption that physical metal exists in sufficient quantity. When too many participants demand delivery simultaneously, confidence erodes. At that point, pricing mechanisms fail. This is not unprecedented. It has occurred repeatedly in commodity markets throughout history. The illusion of abundance persists until suddenly it does not. Silver's small market size amplifies this risk. Compared to gold, oil, or copper, silver is tiny. It does not take massive capital inflows to move price dramatically. A relatively small shift in allocation can overwhelm supply. This is why silver moves are violent, not gradual. When analysts dismiss $100 silver as unrealistic, they often anchor to recent price history. This is a mistake. Price history reflects past conditions, not future constraints. At previous peaks, silver reached levels that would be far higher in today's dollars. Adjusted for inflation and purchasing power, historical extremes already imply prices well beyond current levels. More importantly, those peaks occurred in environments with far less industrial demand and far less systemic debt stress. Today, Global debt has reached levels that make monetary normalization impossible without economic contraction. Policymakers face a choice between inflation and instability. Historically, they choose inflation. Silver thrives in such conditions, not because it is speculative, but because it exists outside the debt-based monetary system while remaining essential to the real economy. The most dangerous phase of this setup is the period of disbelief. When fundamentals deteriorate but price remains flat, complacency sets in. Participants assume the system will continue functioning as it always has, but systems do not break gradually, they break suddenly. Silver does not require universal adoption to reprice. It requires only a marginal shift in behavior, a slight increase in physical demand, a modest reduction in available inventory, a small loss of confidence in paper settlement. When these thresholds are crossed, repricing becomes inevitable. The question is not whether silver will move. The question is whether the market will have time to react. Those who understand this dynamic do not chase price. They focus on structure, they observe supply chains, inventory levels, policy commitments, and capital flows. From that perspective, silver's current valuation is not stability, it is tension. Tension between industrial necessity and limited supply, tension between paper promises and physical reality, tension between monetary debasement and finite resources. When that tension resolves, it resolves violently. Silver does not drift to new price levels, it snaps to them. And when it does, narratives change overnight. What was dismissed as impossible becomes obvious in hindsight. Analysts revise forecasts. Institutions scramble for exposure. Retail arrives late. This cycle has repeated many times across commodities. Silver is simply next. The path to $100 silver is not a straight line. It will be volatile. It will be uncomfortable. It will shake out weak hands. But structurally, the direction is set by forces larger than speculation. ETF inflows, industrial demand, supply constraints, and monetary stress are not opinions. They are conditions. And conditions dictate outcomes. Silver does not need belief, it needs imbalance. That imbalance is already here. What most market participants underestimate is how fragile confidence truly is once it begins to crack. Financial systems are not held together by numbers alone. They are held together by trust. Trust in settlement, trust in delivery, trust that promises can be honored when demanded. Silver sits directly at the fault line of this trust. For decades, the market has operated on the assumption that paper claims on silver are interchangeable with physical silver itself. Futures contracts, unallocated accounts, synthetic exposure, all of it relies on one core belief, that physical supply will always be available if required. That belief has never been truly tested under modern conditions. The scale of today's derivatives market dwarfs the physical silver market. Daily trading volume in paper silver exceeds annual mine supply many times over. This creates the illusion of liquidity. Price discovery occurs in a space largely disconnected from the metal itself. As long as most participants are content to cash settle, the system appears stable. But stability built on assumptions is not stability, it is postponement. The moment physical demand asserts priority over financial convenience, the system is forced to reconcile fiction with reality. This reconciliation does not happen politely, it happens through repricing. History offers uncomfortable parallels. In every commodity crisis, the same pattern emerges. Prices remain artificially contained while inventories quietly shrink. Analysts argue that shortages are manageable. Substitution is proposed. Recycling is exaggerated. Efficiency gains are celebrated. Then one day, supply simply fails to appear. Silver's vulnerability lies in its scale. The entire global silver market is small enough that it cannot absorb large reallocations without distortion. A single sovereign wealth fund, a handful of large institutions, or a coordinated industrial stockpiling effort can overwhelm available supply. This is not theory, it is arithmetic. At the same time, geopolitical fragmentation is accelerating. Supply chains that once optimized for efficiency are now being redesigned for resilience. Strategic materials are no longer sourced purely on cost. They are sourced on security. Silver falls squarely into the category of strategic material. As nations reassess dependencies, stockpiling becomes rational. When governments stockpile, metal disappears from open markets. It does not trade, it does not circulate, it becomes dormant pressure. The energy transition intensifies this dynamic. Renewable infrastructure cannot pause for price negotiations. Solar, grid expansion, and electrification projects operate on fixed timelines dictated by policy and national security considerations. If silver availability tightens, projects will not be canceled. Budgets will be adjusted. This is the defining difference between cyclical demand and mandated demand. Cyclical demand responds to price. Mandated demand overrides it. As more silver is locked into long-term industrial use, the free float shrinks. Markets do not price scarcity until it becomes visible. By the time it becomes visible, the repricing is already underway. This is why silver's most explosive moves historically begin when sentiment is still skeptical. By the time consensus turns bullish, the structural work is already done. Another misunderstood force is the role of interest rates. Many assume higher rates suppress precious metals indefinitely. This assumption ignores the second-order effects of rate cycles. Rising rates increase debt servicing costs. Increased debt servicing accelerates fiscal stress. Fiscal stress leads to monetization, stealth inflation, or financial repression. Silver does not respond to nominal rates. It responds to real confidence. When savers realize that purchasing power erosion is structural rather than temporary, behavior shifts. Capital begins seeking assets that cannot be printed. Silver, because of its smaller size and industrial necessity, responds with leverage. This leverage cuts both ways. Volatility is not a flaw in silver's thesis. It is a feature of its structure. Suppression phases build pressure. Release phases discharge it violently. This creates psychological traps. Investors abandon silver during stagnation, convinced nothing will change. They chase it after repricing, convinced they are late. Those who understand silver approach it differently. They do not treat it as a trade. They treat it as a structural position within a distorted system. Price targets like $100 are not checkpoints. They are reflections of imbalance magnitude. When supply deficits persist for years, they do not resolve at equilibrium pricing. They resolve through overshoot. Markets overcorrect because trust is nonlinear. Once confidence breaks, it does not return gradually. It collapses and must be rebuilt at a higher cost. This is why silver's historical peaks appear irrational when viewed without context. They are not expressions of optimism. They are expressions of desperation. Desperation to secure material. Desperation to settle contracts. Desperation to hedge currency risk. When silver reprices, it does not ask whether valuation models agree. It enforces reality. Critics often argue that technological innovation will reduce silver intensity. Efficiency improvements are real, but they do not eliminate demand. They merely slow growth temporarily. Meanwhile, total system scale expands faster than efficiency gains can compensate. More panels, more vehicles, more servers, more infrastructure, all multiplying silver usage despite per-unit reductions. Net demand rises. This is the paradox of modern technology. Efficiency increases consumption rather than reducing it. Silver stands at the center of this paradox. The longer price remains subdued, the more distorted future repricing becomes. Suppression today does not eliminate future gains. It concentrates them. Markets dislike concentrated outcomes, but they cannot avoid them when imbalance persists. Silver's path forward will not be smooth. There will be pullbacks, false starts, and aggressive volatility designed to exhaust conviction. This is how constrained markets behave. But volatility does not negate direction. Direction is determined by physics, not sentiment. Finite supply, non-substitutable demand. Monetary fragility, geopolitical fragmentation. These forces do not cancel each other out. They reinforce each other. The silver market does not need universal agreement to reprice. It needs only enough pressure to expose the weakness of paper claims. Once that weakness is exposed, repricing becomes self-reinforcing. Higher prices attract attention. Attention attracts capital. Capital tightens supply further. This feedback loop is why silver moves in steps rather than trends. Long silence, sudden shock, new baseline. Those waiting for perfect clarity will miss the transition. Clarity arrives after price adjusts, not before. Silver's role in the next cycle is not symbolic. It is functional. It underpins energy, technology, defense, and monetary hedging simultaneously. Very few assets sit at that intersection. This is why dismissing silver as a relic is not skepticism. It is misdiagnosis. The system does not need belief in silver. It needs silver itself. And that need is increasing. At the end of every major market transition, there is a moment when narratives collapse faster than prices can be updated. Analysts scramble for explanations. Commentators rewrite history. And those who ignored structure search desperately for comfort in hindsight. Silver is approaching that moment. What makes this phase uniquely dangerous is not volatility, it is complacency. The belief that markets will always remain orderly, that liquidity will always be available, and that price discovery will continue to function smoothly regardless of physical constraints. This belief has survived not because it is true, but because it has not yet been challenged at scale. Modern financial systems are designed to defer consequences. Leverage, derivatives, and synthetic exposure allow imbalances to persist far longer than they should. But deferral is not resolution. It is accumulation. Silver has been accumulating unresolved pressure for years. The global economy is entering a phase defined not by growth optimization, but by resource prioritization. Energy security, supply chain sovereignty, and strategic autonomy are replacing efficiency as guiding principles. This shift is subtle but irreversible. In such an environment, materials that are essential, finite, and difficult to replace become strategic assets regardless of market sentiment. Silver qualifies on all counts. The assumption that substitution will neutralize silver shortages ignores a critical reality. Performance thresholds in advanced systems cannot be compromised indefinitely. Solar efficiency, electrical conductivity, and system reliability are not optional features. They are baseline requirements. Engineering can optimize around scarcity temporarily, but it cannot eliminate fundamental material constraints. When optimization reaches its limits, price absorbs the stress. This is the point at which markets reveal their true nature. Prices are not moral judgments. They are rationing mechanisms. When silver becomes scarce, price does not rise to reward holders. It rises to ration demand. Rationing through price is brutal, indiscriminate, and fast. This is why late-stage silver rallies feel chaotic. Industrial buyers are not price-sensitive in the same way financial traders are. When production lines depend on continuous supply, cost becomes secondary to availability. This is how price ceilings fail. At the same time, financial participants face a different realization. Assets that once appeared liquid reveal hidden constraints. Unallocated exposure, synthetic instruments, and paper claims suddenly carry counterparty risk that was previously ignored. When confidence weakens, investors move toward direct ownership, not because they are emotional, but because they are rational. Physical assets regain relevance when trust decays. Silver benefits disproportionately from this shift, because it exists at the intersection of necessity and scarcity. Gold is trusted, but abundant relative to its use. Silver is trusted and consumed. This consumption permanently removes metal from circulation. Over time, this creates a divergence between perceived supply and actual availability. Markets price what they can see. Scarcity develops where visibility is weakest. By the time scarcity becomes visible, it is already severe. This is why silver's revaluation will not be driven by gradual consensus. It will be driven by forced adjustment. Forced adjustments do not negotiate, they impose. The $100 silver discussion often triggers emotional reactions because it challenges deeply ingrained assumptions about stability. People assume such levels require extraordinary events. In reality, they require only the continuation of existing trends. Persistent deficits, rising mandated demand, constrained supply response, monetary erosion, geopolitical fragmentation. None of these are hypothetical. All are observable. What is missing is not evidence. It is acknowledgement. Markets can ignore fundamentals longer than logic suggests, but not indefinitely. Once repricing begins, the conversation changes rapidly. Skepticism gives way to urgency. Urgency gives way to panic. Panic gives way to normalization at higher levels. This sequence has repeated across history, across commodities, across monetary regimes. Silver's turn has been delayed not because it is irrelevant, but because it is inconvenient. Its repricing exposes uncomfortable truths about currency stability, resource limits, and financial leverage. Suppressing silver has been a way of suppressing these conversations. But suppression has a cost. Every year of artificial stability deepens future instability. This is why silver's eventual move will not be gentle. It will correct not only price, but perception. Those who have treated silver as a speculative side asset will be forced to confront its systemic role. Those who dismissed physical constraints will confront delivery risk. Those who relied on paper liquidity will confront scarcity. This confrontation will not be theoretical. It will be operational. At that point, models break down. Historical correlations fail. Volatility regimes shift. Silver does not need to become fashionable to reprice. It needs to become necessary. That necessity is already embedded into modern infrastructure. Energy systems cannot decarbonize without silver. Defense systems cannot modernize without silver. Digital infrastructure cannot scale without silver. These are not discretionary demands. They are structural commitments. As commitments accumulate, flexibility disappears. The market's remaining flexibility lies in price. Price is the last variable that can adjust. When it adjusts, it does so to compensate for years of rigidity elsewhere in the system. This is why silver's long-term trajectory cannot be understood through short-term charts. It must be understood through system dynamics. System dynamics are slow until they are not. The transition from equilibrium to imbalance is gradual. The transition from imbalance to crisis is sudden. Silver is nearing that transition. This does not mean every day will be explosive. It means the probability distribution of outcomes is shifting. The tail risks are no longer remote. When tail risks become probable, markets reprice asymmetrically. Downside becomes limited by physical cost. Upside becomes open-ended. This asymmetry is what attracts serious capital, not headlines. Those who recognize this do not argue about exact timing. Timing is noise. Structure is signal. Structure says silver is undervalued relative to its role, its scarcity, and its necessity. Structure says current prices reflect convenience, not truth. Structure says future prices will reflect reality, not preference. Silver's repricing will not be an isolated event. It will occur alongside broader adjustments across commodities, currencies, and capital allocation. In that context, $100 silver is not an endpoint. It is a reference point, a level at which the market begins to acknowledge what it previously denied. Whether silver pauses, overshoots, or consolidates beyond that level will depend on how quickly trust is rebuilt and supply responds. But trust is harder to rebuild than to lose. Once confidence in availability breaks, it does not return easily. This is the lesson markets relearn repeatedly. Silver is not waiting for belief. It is waiting for constraint. Constraint is approaching. And when it arrives, price will not ask permission. It will simply adjust, upward, decisively, and without regard for prior disbelief. That is how scarce assets behave in a system built on abundance assumptions. Silver is not an exception. It is a warning.